Investing wisely is crucial in the world of finance, and understanding return on investment, ROI, is fundamental to making informed decisions. Let's explore a comparison of two hypothetical investments. Stock X, generating a 50% ROI over 5 years, and Stock Y, which returned 30% in 3 years. The annualized ROI calculates how effectively these investments performed. For Stock X, the calculation reveals an annualized ROI of approximately 8.45%, while Stock Y boasts a higher annualized ROI of about 19%. This comparison distinctly illustrates that despite a seemingly larger total return, Stock Y's annualized performance is superior to Stock X. But there's more to maximizing investment returns than simply calculating annualized ROI. Introducing leverage can amplify those returns dramatically. Leverage refers to the use of borrowed funds to increase the potential return on investment. For example, consider an investor purchasing 1,000 shares of Worldwide Wickets Co. at $10 each with a 50% margin. This means they invest $5,000 of their own money while borrowing the same amount from a brokerage. 1 year later, if the shares rise to $1,250, the investor realizes a notable return. After accounting for dividends and trading commissions, the returns remain impressive, making leverage a powerful strategy for boosting ROI. However, leverage is not without its risks. Take the same investment scenario, but with an unfavorable outcome. If the share price plummets to $8.00 instead of soaring, it would force the investor to confront losses. According to the ROI calculation here, losses can be magnified due to the margin loan. In such cases, the investor would sell their position, locking in the loss while still needing to satisfy the outstanding margin loan, demonstrating the inherent risk of leveraging capital. In summary, understanding and calculating ROI are imperative in evaluating the efficiency of investments. Balancing potential gains against the risks posed by leveraging borrowed funds can mean the difference between substantial profits and significant losses. Investors should carefully consider not just the numerical returns, but also the underlying conditions of their investments and market fluctuations to navigate the complexities of the financial landscape effectively.
Understanding return on investment, ROI, is crucial for any investor delving into the financial landscape. The concept, distilled into a percentage, transforms complex data into understandable metrics. By calculating ROI, investors can gauge the efficacy of their investments, making informed decisions that can lead to enhanced profitability. A positive ROI signifies that total returns surpass total costs, while a negative ROI indicates potential losses, urging due diligence before investment commitments. To accurately compute ROI, one must first account for net returns in the calculation. This entails considering total returns, including any capital gains and dividends, alongside total costs which encompass the initial purchase price and any incurred trading commissions. A simple formula ties these elements together, yet the elegance of this equation belies the intricacies involved in determining the figures that fill it. Every investment vehicle may present unique challenges in accurately defining these amounts. Consider a hypothetical scenario involving the purchase of 1,000 shares of Worldwide Wickets Co. at $10 each, then selling them at $12.50 a year later, while also receiving dividends and encountering trading commissions. When calculated, the ROI reveals itself to be 28.75%. This figure does not merely reflect profit, it encapsulates the journey of the investment. Breaking down the ROI further unveils individual contributions from capital gains, where returns are proportional to the increase in share price, coupled with the dividends which provide a consistent income stream, and commissions which reduce overall returns. These segments offer insight into the performance of the investment, making it easier to assess where the gains arose and guiding future investment decisions. In summarizing ROI, one must also appreciate the nuances of taxation on different income streams. Understanding that capital gains and dividends are taxed at varying rates emphasizes the importance of a thorough financial strategy. Seasoned investors often dissect their figures to ascertain the most effective allocation of resources, striving to maximize returns while minimizing costs. In essence, ROI is not only a measure of success, but a comprehensive tool that, when harnessed correctly, can pave the way for informed and lucrative investment journeys.
Investment returns can be tricky to navigate, but understanding the concept of return on investment, ROI, is fundamental. A positive ROI indicates that net returns are exceeding total associated costs, whereas a negative ROI signals an undesirable scenario where total costs outstrip returns. Knowing these basics sets the groundwork for more intricate calculations, such as annualized ROI, which incorporates the duration that an investment is held. This is essential for potential investors aiming to understand the true value of their investments over time. The formula for calculating annualized ROI stands out as an important tool. Annualized ROI follows the 1 plus ROI, RSD1, N, 1x 100%, where N represents the number of years the investment is held. For instance, suppose we have an investment yielding an ROI of 50% over 5 years. The average annual ROI, calculated merely by dividing the total ROI by 5, offers an overly simplistic perspective, suggesting a 10% annual return. However, real-world scenarios often showcase the power of compounding, which becomes especially pronounced over extended periods. By applying the annualized ROI formula in this case, we unveil a more nuanced annual earning that accurately reflects investment growth, 845%. Moreover, annualized ROI calculations can even accommodate shorter holding periods. If an investment produces a 10% ROI over 6 months, a mere average would suggest a 20% annual return. Yet the annualized formula computes this to be a more robust 21%. Such calculations are invaluable for investors as they starkly illuminate discrepancies that simplistic average methods might overlook. An alternative ROI assessment could involve transactional costs, say commission fees incurred while buying and selling shares. By adapting the formula to include these fees, investors can achieve a clearer picture of their performance. This comprehensive understanding enables investors to gauge varied investment opportunities accurately and ensure informed decision-making. The concept of return on investment, ROI, serves as a cornerstone in evaluating the effectiveness of financial investments. Calculating ROI allows investors to assess the profitability of their ventures by comparing the net profit against the initial investment. Understanding this metric is vital. For instance, with an IRR of 64%, an investment of $100,000 yielding a total cash flow of $25,000 over 5 years looks favorable. However, the timing of these cash flows can skew perceptions of profitability significantly, suggesting that the sequence of receipts plays a crucial role in evaluating investment performance. In financial analysis, the IRR function highlights how cash flow timing affects ROI. A scenario with larger cash inflows within the first 4 years presents an IRR of 64% as opposed to 5% when cash flows are evenly distributed. This disparity illustrates the time value of money, emphasizing that early returns not only bolster confidence, but also enhance overall returns. This underscores the importance of not merely looking at total cash flows, but dissecting when those inflows occur to paint a clearer picture of the investment's health. Despite its simplicity and universal recognition, ROI does possess some pitfalls. Notably, it fails to account for the duration of an investment. For example, an investment showcasing a 25% ROI over 5 years cannot be automatically deemed superior to a 15% ROI investment that matured within 1 year. This limitation can obscure the true profitability and desirability of potential investments. Additionally, ROI lacks a risk adjustment, which can mislead investors, particularly in volatile markets. A higher ROI may coincide with greater risks, and without assessing both, one may face unexpected losses. Moreover, calculating ROI can sometimes inflate returns if not all costs are factored in. When evaluating various investments, such as real estate, uncertainties like mortgage interest, property taxes, and maintenance costs should be accounted for, or the ROI may seem overly optimistic. Hence, investors need a comprehensive approach, considering both the anticipated returns and the potential risks and costs to make informed financial decisions. In conclusion, while ROI is a vital metric in assessing investment success, it should be complemented with other analyses to truly gauge the viability of opportunities.
Leverage can serve as a double-edged sword in investment scenarios, magnifying returns significantly when investments flourish, yet equally capable of escalating losses in adverse circumstances. Consider a hypothetical investor acquiring 1,000 shares of Worldwide Wickets Co. at a reasonable price of $10 each, while utilizing a 50% margin to do so. This means they invested $5,000 of their own funds and financed an additional $5,000 through a margin loan, thus entering the world of leveraged investments. As the story unfolds, 1 year later, the investor sells their shares for $1,250 each, bringing in a substantial profit. Together with the dividends accrued over the holding period, totaling $500, the investor faces a series of transaction fees, including $125 spent on trading commissions and interest on the margin loan at a hefty 9%, equating to $450. For an insightful calculation of return on investment, ROI, these variances need consideration. The ROI formula used here reveals that despite margin interest impacting the net return, the investment still delivers a striking 485% ROI, far superior to the 2875% that would have been realized without leveraging funds. However, let's not overshadow the potential peril of declining investments. In a contrary scenario where the price dips to $8.00, the investor is faced with not only a decision to sell, but also reaping the consequences. When calculated, the ROI falls to 415%, an outcome substantially worse than 1625% had leverage not been applied. This stark contrast depicts the complexity of leveraging in investing. It propels fortunes, but can equally precipitate losses. Furthermore, real-world investments rarely yield uniform cash flows, complicating return calculations even more. In scenarios reliant on varying cash flows over time, such as a proposed investment of